It's February, and Canadians are getting ready to prepare their
taxes. The finger thing means the taxes.
That's right, it's tax season. For investors, the most common tax they need to think about are capital gains taxes. If you're new to investing and haven't had to declare investment gains on your tax returns before, you may be unfamiliar with how they work. Let's take a closer look at capital gains taxes to clear some things up. Before we explain how capital gains taxes work, there's one other thing you need to remember. If you're making a capital gain on an investment held in a registered account, like a TFSA for example, you don't need to declare that capital gain as income. But if your investments are in a non-registered account, those capital gains will need to be declared. For those who don't know, a capital gain is made when you sell an investment for more than you paid for. For example, let's say I bought 500 shares in Company X at $5 per share in April of last year for a total of $2,500. Come September, Company X shares are trading at $15 per share, and I decide to sell my shares for $7,500. That means I've made a capital gain of $5,000. So how will that be taxed? In Canada, 50% of your capital gains are taxable, also known as the inclusion rate. Many people are confused when they hear this and believe that they will pay 50% of what they gained as tax. That's not how capital gain taxes work. For our previous example, when we made that capital gain of $5,000, with a 50% inclusion rate, that means we must declare $2,500 as taxable income. How much tax you'll actually end up paying on it will depend on which tax bracket you fall under. One other common area of confusion around capital gains and taxes is that only realized capital gains are taxed. To explain what that means, let's look at our example again. The securities I purchased for $2,500 have increased in value and are now worth $7,500. The capital gain of $5,000 is not realized until I actually sell the securities. The capital gain that has not been realized does not need to be declared on your taxes. When doing your annual income tax return, if you have any questions or are unsure of anything when it comes to your investments, always consult your advisor and a tax expert. And that's the basics of capital gains taxes.
The finger thing means the taxes.
To learn more about investing, visit our website and follow our social media channels to find out more of our investor education content.